Hello everyone, Josh Yamamoto here from InvestorThread.com. Now, recently I wrote an article about FedEx, that is ticker symbol FDX. And I mentioned that there are concerns about the company because of its recent poor earnings disclosure. And as you know, FedEx is a major company. And because it's also an economic bellwether, this is really where the literal economic rubber meets the road. There are anxieties associated with FedEx because management also disclosed that the future quarters are going to be challenging. So that may have negative implications for the economy. However, FDX stock has already been punished by the market, if you will. And so following that poor earnings disclosure, the security lost a significant amount of equity value. And so my mainline thesis is that the market has already penalized FedEx for the publicly available news. And so unless there are more negative news that's about to come online, the anticipation here, the thesis here is really that most of the bearishness has been baked into the price, and that moving forward, it's likelier that FDX may march higher, or at least somewhat in a bullish direction. Maybe at worst it just kind of goes sideways. Now, of course anything can happen, but generally I think with so much negativity already baked into the price, I think there is a higher risk that to assume that even more damage can occur, because we've already essentially heard the worst. So it may behoove investors to consider the long side of the trade. Now, here is where things get interesting. FedEx, it's a quote unquote a high priced security, and its call options, even those that are near expiration, are relatively expensive, especially for the average retail investor or retail trader. So if you buy a call option, the one that I identified in the article that I wrote for Investor Thread, which I think it was definitely a call that expires next Friday, October 4th. I think it was a call with a strike price of $262.50, if I remember correctly. The premium for that call option is $4.50. So if you apply the option multiplier, you're talking about $450 for a call option that will expire next Friday. So it's Thursday right now. So you have 1 week and 1 day for this call option to do its thing. Instead of buying a straight call option, I suggested the idea of considering a bull call spread. Now, bull call spread is very similar to a call option. Now let's back up a little bit here. A call option, if you were to buy a straight call option, let's say for that strike of $262.50, you would pay the $4.50 premium, and that is your total debit that you pay. We're not going to include the whatever brokerage fees that are that may be included as to participate in this trade. We're just looking at the premium itself. So you're going to have to pay $4.50 or $450 per contract. Okay, you can take that risk, and the idea of buying that call option is that once the underlying security FDX breaks above the break-even price, then anything above that break-even price, we're assuming here intrinsic value at expiration, anything above that break-even price is pure profit in your pocket. Okay, but the problem here is that the break-even price, again, at intrinsic value on expiration, is is whatever the premium is added to the strike price. So I think that if I remember the math correctly, the FDX stock, in order to go up by $4.50, that's about a 1.2% increase from Wednesday's closing price. Okay, I know this is Thursday, the market is already closed. I didn't check what the exact price was. I know that it did move up, but FDX would need to move up based on Wednesday's close by about 1.2%, if I remember correctly, for the security to just break even. Now, compare that to the bull call spread that I talked about as a trading idea. With the bull call spread, you do the same thing as a straight call option. You buy the 262.50 call with the premium of 450, but you also sell a call option at a higher strike price. I forget exactly what that call option was in terms of the strike price, but I remember that the premium was $3. So you receive, because you're selling the call option, you receive a gross premium of $3. So you take that $3 and you subtract that out from the $4.50 that you paid as your gross debit, and your net debit becomes $1.50. So you're going to pay that net debit for this bull call spread. That $1.50 is essentially the maximum that you can lose on this trade, because if the trade goes squirrely, you have a bought call and a sold call. So they essentially they counter each other out. So you have limited risk. At the same time, you do have limited reward, and that's where people get a little bit hung up with these strategies that are known as vertical spreads. The reason why people get hung up is because if FDX stock in this case, let's say it moved up to $500. Okay, so on Wednesday it closed. I forget exactly, but it was like 263 or something. So let's say it closed at $500. So with the straight call option, that is again gravy. Anything above the break-even price to $500, that difference is pure profit that you just take home. Okay. With the bull call spread, because you sold the call option, you're capping risk, but you're also capping reward. And in the bull call spread that I mentioned recently, the maximum reward that you can achieve in this setup is $100. It's $1 of premium, or $100 in terms when you multiply the options multiplier. So even though on paper, if you bought a straight call option, let's say you profited $5,000, for example. Let's say that FDX did go up that high, so that you would have profited $5,000 by buying a straight call option. No matter how awesome FDX becomes in a bull call spread, in this particular case, you would only make $100. So people, naturally are maybe up in arms about that. Here's the thing that you will need to consider. If you're not that confident in a particular trade, you're only moderately confident, then a bull call spread may make a lot of sense. Because obviously if you have an idea that is the highest conviction idea, you're gonna want to go for a straight call. That's like going for a long pass to get the touchdown. But sometimes the defense messes with your offense, and you just you get muddled in the middle, and you can't quite get into the end zone. Okay, are you just gonna go for it on fourth down, knowing that the defense is really stingy, or do you want to just put some points on the board and kick a field goal? A bull call spread is like a field goal. You're going to put some points on the board. It's not as sexy or exciting as a touchdown, but you're putting points on the board. And especially with something like FDX, a security that doesn't move as much as, say, a penny stock, right? It's going to have generally low beta. So you're not going to see these wild gyrations. There's nothing exciting about a global courier. It's not an artificial intelligence play like NVIDIA. It's FedEx, okay? So with FedEx, it's probably unlikely that it's going to go up by 1.2% in less than a week and a half. So with a bull call spread, you're making the bullish debit cheaper, okay? So instead of paying a debit of $4.50, you're paying a debit of $1.50. That's a cheaper debit to engage the same bullish trajectory. On the other hand, this is where you really have to think about this, is that because the debit has been cheapened, if you will, the threshold to profitability is much lower. So you don't need to move the ball as much to score some points. Again, it's not as sexy as a touchdown, but a field goal puts those points on the board for your team. And that's great if your goal is to win the game, to put wins on the table for the entire season. This is why a bull call spread can be advantageous. Now, I forget the exact numbers, but to break even on the bull call spread that I talked about, based on Wednesday's close, you only need the stock to move up by less than 0.1%. So essentially, by the expiration date of next Friday, FDX stock just needs to be up less than 0.1% from where it was on Wednesday. That's a compelling deal, because remember, on the straight call, you would have to go up by 1.2%. So 1.2% versus 0.1%, are you kidding me? That's a great deal, right? That's a great deal, because you don't know if FDX is going to go up by 1.2%. And here's the kicker, okay? For the straight call to generate a profit of $1 or $100, the security FDX stock would need to rise by 1.6% by expiration. 1.6%. With the bull call spread that I mentioned, you only need to move up by 0.5%. I think it was 0.47%. 0.47%. I don't know about you, but I don't have a whole lot of confidence that FDX can move up 1.6%, because it's still FDX, it's still FedEx, it's still a global courier. It's not the most exciting business. Plus, management has already disclosed that it's going to suffer some challenges in the future quarters. So you have the fundamentals saying, hey, it's this isn't a great time for our business. That's going to pressure the security, right? And the investors are digesting that. So I don't know it has gone down, and I do think that it will eventually march its way higher, but how much higher given the poor fundamentals? I don't know about 1.6%. I don't know if from Wednesday's close, I don't know if FDX has 1.6% in the tank. I do believe that it has 0.5% in the tank, right? So with the bull call spread, let's say it only moves up by next Friday. Let's say FDX only moved up by 0.5%. You would put $100 in your pocket because it only moved up 100%. But hey, that is what was necessary to receive the maximum reward for that trade. Now consider that you bought a straight call option and FDX only moved up by 0.5%. You're not pocketing $100. No. You're pocketing a loss of $450. So I don't know about you. You have a choice. Do I make $100 or do I lose $450, right? Now, of course, anything can happen. FDX can go to the moon. I don't know, right? I'm not, we're dealing with probabilities here. We're dealing with anticipation of other human traders' sentiment. So I don't know. But to me, that seems like a very compelling deal. You have a really good chance of making $100, or you have a really strong chance of losing $450 if you go with the straight call option. But the straight call option, there's that temptation that your reward is theoretically unlimited. Well, yeah, it's theoretically unlimited, but is it practically realistic to assume that FDX could drive up almost 2% for you to generate that $100? With the bull call spread, you only need that 0.5% move, 0.5% to get that $100. That's why I said grab a Benny before the start of next weekend. This is compelling stuff. So I encourage you to read that article. I'm also going to include in the link under this video a link to my bar chart article, which shows how you can exploit these profitable opportunities. It's in my opinion, it is the greatest trading platform that is available in the market. And we're talking about a very, very nominal fee. It basically works out to a Netflix subscription. A Netflix subscription to make bennies. You compound those bennies before the weekend. I mean, I can't stress to you how much power you're going to put in your hands with bar chart Premier. Okay, I know that there is the free bar chart, but if you upgrade to bar chart Premier, it's going to revolutionize your trading. It's going to fill you with knowledge, and you're going to have all the tools that you need to know when the hand is hot and when you can essentially wager a greater amount, and when the hand is cold and you may deploy a different strategy. So we're gonna talk more about these trading ideas, these opportunities. So anyways, I'm gonna check out, I'm gonna put that link for the bar chart article. Do yourself a favor, please check it out, because this is going to absolutely revolutionize your trading. And as always, if you want more trading ideas and education, please check out investorthread.com.